Hey, what's going on, cash flow hackers? It's Chris, and welcome back to the Understanding Your Money series. This video, we're going to be talking about not just the importance of saving money, but ultimately where are the best places to save money. So think about it this way. I've done other videos, and I'm going to do more videos that get into how to properly structure your financial life. But the bottom line is, one of the most important components of personal finance is building your financial foundation of safety. And so I always kind of say there's kind of two decisions that we have in life, when it comes to getting our financial life going. And it is like, A, do I believe that I need to save or invest first, which a lot of people are taught the younger you are, the more risk you can take. So we should go out and just start swinging for the fences and taking on all this risk. But the bottom line is the younger you are, the less risk you have to take because you have time. And if you're just consistent and you can avoid losses, then you can get where you want to go. It seems to be only in the financial industry have we been kind of tricked into believing that the younger we are, the more risk we can take or should take, because of the fact that, like, if you think about it, risk simply means the higher the risk, the higher the chance of loss. So it's basically like me saying, hey, let's go drastically increase your chance of losing, and that's going to get you where you want to go. And when the reality is this should be the opposite end of that. The younger you are, the less risk you have to take. You just got to have a good, consistent plan. The older you are, if you're not near where you want to be, that's when you got to start taking risks to make up for lost time, right? And so I think when you really back that out and logically, kind of break it down, it starts to make sense, right? And so, for this video, what I want to do though is say, okay, if you believe that before you go invest, that you need to be saving as a foundational element of your life, of your finances, that you need to save before you invest, because when you do, that puts you in a position to act like an investor instead of a speculator, and you take advantage of the opportunity that comes along with it. Then the second question, once you agree that you need to save before you invest, the question is, where do I save my money? Because now we're kind of at a loss. Like, we can, before I get into these things, I'm gonna get into, like, where can you save your money? Oh, I gotta get here. Where can you save money? You can save it in savings accounts, CDs, certificates of deposits, usually done through banks, and credit unions, right? You can do bonds. These are typically the safe places to go. The problem is these are not liquid. Bonds are typically not liquid. Savings accounts are very liquid, right? And so that's what people are going for. CDs and bonds have low rates of return. Rate of return is poor. Savings accounts, the savings accounts, or I guess CDs and bonds, the rate of return is better than a savings account, but still poor, but they're illiquid to go with it. And the savings accounts have very bad rate of return. Rate of return is bad, but they're very liquid. So it's always this balance of liquidity versus return, and so on and so forth. And so the question is like this: if these are the accounts that traditional people are just thinking are the only options, well, then you're dealing with incomplete information. And I think a lot of that happens because a lot of people like Dave Ramsey and Susie Orman have spoken against the product that I believe is one of the best places to save your money, and that is a properly designed whole life insurance contract. Now, before you go run for the fences and before you have a freak out session on me, let me tell you this: it is not your traditional run of the mill life insurance policy, whole life insurance policy that Dave Ramsey loves to hate on. This is a specifically designed leverage machine that I'm going to show you exactly what it looks like here. And I think by the time I'm done showing it to you, if you have a preconceived notion about what whole life insurance is, that notion is going to get turned on its head. So without further ado, let's get into this. So what I'm going to do is I'm going to share my screen here, and I'm going to get into this, and I'm going to come at this kind of from two perspectives, right? We're going to come at this from two angles. First off, we're going to come at this from the angle of saying, okay, in that scenario, what we have here, we have, let me see, I got to get to the green marker because I got a white background here. So you can see here, imagine you believe that you have to pay yourself first. That is a financial principle for success. Before you go spend all your money on all your other bills, pay yourself first, save your money, build your financial foundation, right? So this is somebody that can save $10,000 a year. I'm gonna use this as an example. So if you're starting from scratch, you go with $10,000 a year, and it's, you know, $10,137 here, as you could see. But what that does is it gets you life insurance with it. It gets you living benefits, right? It gets you access to this capital. So what you can see here is there's a net cash value here. Now, out of the $10,137, you get the life insurance, you get the living benefits, you get the tax advantage growth of it, but you also get this cash value right here that's available virtually within 30 days typically of when you start the policy. Now, what happens here is year 2, you can see you contribute $10,137. You could see here the increase in net cash value of this policy goes up by $9,762. Okay. Now, I want to tell you, like, these numbers will fluctuate a little bit, but this is just to understand the principle, okay? So like that's the key thing to understand. Now, when we look at this, where is it going to where by the time year 3 happens, where we pay that $10,137, the policy's growing by $10,223, and we have more life insurance. You could see this life insurance number keeps getting bigger and bigger every single year up until time goes on where it drops a little bit because the term rider drops off. That's a whole different video, but you could just see the concept here of where to save. And this is just, the whole concept here is this is a savings account on steroids. It is ultimately getting your dollars to perform more than one function in your life. Now, here's the deal. A lot of people don't realize this. The reason I call this a savings account on steroids is because A, you get the living benefits, you get the death benefit, you get access to the cash value, you get it to grow, and you can see by year 10, when we've contributed accumulation of $101,000, we have $115,000 of cash value plus $377,000 in death benefit. Now, a lot of people look at this and they go, oh my gosh, I think if you look at this, I guess, it becomes a no-brainer, right? Because you get this extra death benefit. This outperforms what a savings account would have done. And now you have living benefits and you have all the tax advantages that go along with this to boot. And that looks pretty phenomenal just as is, right? And this, when you understand it, when we start thinking long-term, a lot of people don't want to do this because they go, oh, well, if I don't have access to all $10,000, well, we got to think long-term. If you keep making short-term decisions, it's going to have a consequence, right? We got to think long-term. Your goals are long-term goals, so you got to start planning with a long-term financial strategy. And if you pay yourself first and you utilize this, I think the one thing I want to say is when you utilize this, you're utilizing it as a savings vehicle. This is your emergency fund, and this is your opportunity fund. Okay, when you build it like this and you understand you're saving for emergency to protect yourself in case of a market downturn, and you're saving for opportunity because in those downturns, there's more opportunity. It's like Warren Buffett always says, make money when there's blood in the streets. Don't make blood when there's blood in the streets. Then you're just contributing to the problem. But that is that. Now, here's the deal. This is for somebody that's kind of starting, and I gotta get that back in alignment there. This is for somebody who's just starting, and that's fine. But the bottom line is, I know some of you out there are gonna have the ability, I got that all messed up. Some of you out there are gonna have the ability where you have money saved and you're trying to figure out how do I optimize what I'm doing right now. Maybe you have money saved in a savings account, maybe it's in a CD, maybe it's in a bond, maybe it's something and you're looking to get those bond-like returns with the savings account liquidity. That's what this is, right? And so what we're talking about here is the same rough $10,000 per year. You can see right here, this $10,000 annual premium, but you see the first year is $110,000. So this is assuming that you have $100,000 sitting somewhere. Maybe you inherited the money, maybe you've been diligent and you've actually saved it up and you're tired of that money losing to inflation in the economy that we're in right now. It is what it is. I don't know what you have going on. This number doesn't have to be the full $100,000 above the $10,000. I'm just showing you this because this is what you could do. You could put up to that amount in there if you wanted to. And so you can see here, by the time year 10 rolls around, you've contributed $200,000 total. You have $227,000 in cash value with $1.9 million of death benefit. Once again, if you're looking at this, it gets even better because year one, yeah, you've given up because you only have $101,000 of cash value, $101,008. So you basically lost I don't know, $8,200 of liquidity, but you didn't really lose it. What you did is you gained all these other benefits that I talked about, right? The death benefit, you basically handled that. And then year two, from a cash flow perspective, it's positive already because you're contributing this $10,000. The policy is growing by more than $10,000 right here. You can see the increase in net cash value has grown by more than you're actually contributing, and it just gets better and better and better and better and better and better and better every year. And a lot of people go, hey, Chris, how long do I have to pay for this? How long do I have to contribute to the premium? The answer is year 7 is the requirement. So you got to figure out whatever number that you do, you got to be able to handle it for 7 years. But once again, if we go back to the concept of paying ourselves first, this becomes a no-brainer. It just becomes a complete no-brainer. And so, but by the time you hit your 7, my answer is, once you've done that, you've already taken care of all the expenses and like all the major fees in this. Why would you ever want to stop contributing to this? Because below this line, this is the most financial efficient vehicle that you will ever find. And as you've probably been learning, if you've been watching this entire series, life is about financial efficiency. If you want to achieve your goals with a more predictable level of certainty, you need to increase your efficiency. And that's why I love these policies. It's going to help you operate more efficiently. And once again, this is not just any policy. This is a specifically designed whole life insurance policy that you need to work with people that do that. And full transparency, my organization does do this. We help people, we consult with people, and can help people set these up. If you are interested in that, I don't do it personally. I have people that do it. You can go down the link below and you can have a free clarity call with any of them to help set it up. But once again, this goes down. It may not be the right time for you. You may be in debt. You may have issues there. Once again, even if this isn't right for you, I really encourage you to set up that clarity call, have a conversation with somebody, figure out, get complete clarity around what your personal financial life is like, lay out a plan of goals of where you want to go, and then, only then can you reverse engineer your path to be able to get there, right? And so this is just really, really important when you really break it down and you think about where are the classic places that you can save money. Most people think banks, CDs, bonds, banking type products, things like that. They don't really think of the fact that life insurance companies, when you do this properly, they are the best in the entire financial world across the globe at maintaining the purchasing power of your money. These whole life companies have been doing this literally since 1840. And when you look at that, that's before the Civil War, before Lincoln was president and assassinated, before the Great Depression, all this stuff. And these guys have paid these dividends. You see annual dividend. They've paid these dividends every single year for every year in existence of the company, every company that we do any kind of work with that we would suggest you to get a policy with. So you got to make sure that it's with the right company, that it's got the right design to it, and that it's fit to meet your needs. So if you have any questions about that, comment in the comment section below. If you have anything else you need, any deeper questions, that you feel like you got a personal situation you want to get into, go down in the description, set up a clarity call with somebody on my team. They're happy, completely complimentary, no pressure. And if they do pressure you, you just leave me a message and let me know, and I'll go get them for you, because it is a no pressure, all service call. We are looking to just add value to your life to help you get more clarity about what your goals are and how you can get there. So any questions, do that, reach out. If you haven't already, make sure you subscribe to this channel, because these videos on the Understanding Your Money series, I'm coming out constantly. I think we're about halfway through our 30 video series at this point in time. So if you haven't already, go back and watch it from the beginning. The playlist here is going to be on the end screen here. You can go see in the top right corner of the video right here. It might be showing up now. You're going to see it. Click on that video and go check it out. I'll see you on the next video. Have a blessed, inspirational day. We'll talk soon.